This works.
I think we're live.
Yes, you are live, it says. Hi, everyone. I hope we are live. If we are live, you can start commenting and chatting with us. I have Shastra with me as promised. This is our first live endeavor where we are trying to do this. If it's successful and you guys enjoy, and if you do enjoy this kind of format, we will try and do this more often, and we will get these questions answered in an interactive manner as both of us are available to see your questions and try and answer them. So, what we wanted to talk about today was a Financial Times article where they had spoken in great length and analyzed why the foreign institutional investors are starting to check out of Indian market. And I thought Shashwat can first open about that, and then you guys can drop in your questions, and we'll try and talk further about that. Yes, Shashwat.
Yeah. So, hi to everyone who's watching us from back home. I hope that this Friday evening is a nice evening, and I'm glad that you guys have decided to spend it with us. So, that being said, I want to discuss this article which you've sent to me. So, this article is basically, well, I mean, yes, this article is important, of course, but the larger context is that we have seen this trend happening even regardless of the article. We've seen that FIIs are pulling out money from the stock market, and the Nifty over the past month has cracked by, I think, if I'm not wrong, 6% over the past month. And over the past 5 days alone, the Nifty has cracked by around 2.35%. So, when when we have this percentage drop, the question naturally is this going to be sustained? Why is this happening? And if this is happening right now, does it mean that this is going to turn around at some point? So that being said, the first point here is as to why this might be happening. There are multiple reasons as to why this is happening. First of all, as we've said on this channel, a market that is overvalued does not need a specific reason to correct. So that's the first point. Secondly, a market which is undervalued does not need any reason to perform well. So keep these two statements in mind and examine India and China. So you look at India and China. One is a market severely undervalued by the PE terms. Let's not maybe debate on whether it's fairly valued or not, depending on China's economic conditions. But from an objective point of view, according to metrics by the PE ratio, say China's market is definitely considered in the undervalued territory. So when an economy is in the undervalued territory, and then you have the opposite of an economy in the sort of overvalued territory where you're well above the mean PE, and that's the Indian Stock Exchange, or rather the index, the Nifty 50. So the Nifty 50, with any sign of bad news, has reasons to collapse in terms of prices, and the Chinese stock market, with any signs of positive news, has reasons to bounce and take up. So when you have these two emerging markets, and then the question between FIIs is whether we have to park funds in India or in China. So if you were a fund manager and you had one country that is severely undervalued with signs of maybe positive news, let's not say that this is wholly positive because we don't know that yet, but some signs chatters going around. And then you have India, where you have multiple companies which have missed their earnings numbers. You have multiple companies which are suffering because of the lower income class not performing so well, or not being so economically strong or robust. So their numbers are also not robust, these companies. For example, Indocent, and let's take another example of Manapuram, or even the Spandana Sphurti company, which we talked about. The point here is that these companies are heavily dependent on how the economic strata of households in India perform. And if households in India are sort of on the end of suffering, then these companies' profits are also going to suffer. So, that being said, when your market is overvalued, even seemingly bad news, like even seemingly let's say slightly neutral news might end up tanking your market, which I think is what's happening now, because FIIs are seeing that the market is sort of overvalued, and they're taking some money out of it and putting it into a market where there is some news of positive waves, and they're putting their money into China. So I think that's what's basically going on if I were to examine that situation. So what do you think about this?
You're right. And even like you said about stock market, FIIs have only a few reasons to buy and sell. And everyone assumes FIIs have the same investing principles what we have. Each person who comes to the market, who participates in the market, has their own set of agendas and goals which they want to meet. Like how some people want to buy active funds, though we are against it. They buy because they have a certain goal to meet and they believe buying those funds meets those goals. And if you look at foreign institutional investors, you have to understand where they're coming from and what is their intent. And that is very important because we assume when foreign investors buy something, they're buying it for value. If they're selling something, it's purely because it is overvalued. It's not as simple as that. When foreign institutional investors, they're given direction by the people who are giving them money. And most of these are sovereign wealth funds, they're pension funds, or they're high net worth individuals who are willing to take a portion of their wealth and see if we can make a bet and get a huge return. And they pass it on to these fund managers and tells them, okay, go to emerging markets and see what you can do. And you must understand something. The foreign institutional investors, the people who are giving them money, they are not here. They're not in India. They're not in China physically. They do not know Indian markets themselves. They do not know Chinese market themselves. So they react on news channel news. They react on macroeconomic trends. So if they see Indian corporate earnings not being great, they immediately feel the Indian market is not going to go anywhere. They don't try and understand the nuances of it. And they'll immediately react and say, okay, they'll have a knee jerk reaction and saying, okay, let's pull the funds out. That is why market moves, FIs move on macroeconomic data a lot. This will be even true for you. If you're investing, let's say, sitting in India, you're investing in American markets, you do not know about a lot of companies. And let's say you are starting to broadly look at the whole American market and you start picking on stocks just based on PE and the history, and you do not know anything about the company or the owner. And you hear some news like Kamala Harris was supposed to win, and now Trump has won, and it's a big shock. You, as an investor, don't know what is going to be the layout, how it's going to affect this company. What is the new cabinet going to do, which is going to affect this company? So you'll tend to pull out your money and say, okay, I'm a foreign investor in US. I'll pull out and wait and watch. So that's the kind of attitude foreign institutional investors have in India. And the second thing you have to remember, they have, like I said, they have a specific goal to meet. So that goal is to get a certain guaranteed return for their main customers. So these pension funds have to pay out pension every year. These have to be mandated and met. So the foreign institutional investor, who's the fund manager, has to make sure these pension fund he can play around and at least generate this much income. So like how Anand says, you buy 10 shares, if four or five of them become multi-baggers, you have recovered the money you've lost in the others which failed, and you would have made a profit, handsome profit too. So that is the kind of attitude they have, not just in stocks, in markets. So that's why even in the Chinese market, there's an opportunity there because the government is even not clearly said before the government even clearly said what the plan is. Xi Jinping came out said yes, we're going to do something for the economy. Well, he just broadly said that, and they started running to it because there's a great opportunity. If you take only a small percentage, to us it looks like a lot of money, but in their terms and dollar terms, it's a very small fraction of money which they're moving out of India and moving it there. Out of all the money they have distributed all over the world, including their domestic market where they've invested in bonds and debt and sovereign bonds, if you take all of it, like let's say take like the Sweden's, oh, what is it called? Their um, sovereign fund. Sorry, for a moment I lost my train of thought. Like the Swedish sovereign fund or the Saudi sovereign fund, it runs into trillions of dollars. So it's only a small fraction. For us Indians, it looks like a large amount, but from their perspective, when they're moving, it's a small amount. And this is very apparent when they're selling. And what has been happening in the past was when they pulled out, the effects were dramatic. Now what's happening is Indian investors have started pouring money into stock market, and we have started overtaking foreign institutional investors, and we actually sway the market quite a lot as much as they do. So now what's been happening during this bull run is each has been playing off the other. So, each time one will push up one, the other will buy, other will sell. So they've been swapping money by selling and, high-fiving each other through the market. But now what's happened is foreign insurance investors have told DIS, if you want to play, you're welcome to play. We have decided to leave. So this is where it starts getting interesting. To be honest, why they're leaving is not a worry for us. The question should be when will they come back and why will they come back is more pertinent, is what I feel. So Shashwat, when do you think, on what do you think should happen for FIIs to come back to Indian shores? Because that will create another fuel, another run, right?
Yeah, well, first of all, I mean, we have to first look at whether enough of them have actually left for this to be considered a big enough, I don't know, say a run from the Indian markets. If you look at the Nifty's performance, still past 6 months, it's performed quite well. It's still up. It's in the green, and the return is quite handsome, which it's given you over just the past 6 months. It's given you plus 6% in half a year. That's a huge return. Most people, get less than 6% on their savings account at the end of the year. And then secondly, if you look at its 1 year performance, it's still up 20% from the previous year. So, what I'm trying to say here is that I don't think this is a big enough dent to be counted as, let's say, a big run from the Indian markets. Yes, DIS have been putting in a lot of money and have been floating the market when it might have collapsed even further if domestic investors didn't come in to basically, let's say, float the market. But the point I'm trying to make here is we still have some way to go before we can consider this a big enough shock where people have left your market and now suddenly you're left wondering what's going to happen, whether they're going to come back. I think it could be as simple as China's stimulus plans not following through, and it could be as simple as Xi Jinping doing something wrong, something perceived as wrong, which causes money to flow back into India. I think that's one thing. Secondly, it also depends finally on how the Indian economy performs. So I can't really tell how the economy is going to perform in the upcoming years, but depending on what kind of growth we see, whether it's robust, whether it's strong, whether it's able to withstand a global market which is shrinking, which is sort of putting up borders. If the Indian economy is able to withstand that pressure, then we may be back in business. But looking at how the global market is reacting to people coming into power, I mean, we don't need to name names. Look at the US, look at anywhere else in Europe, and look at India, look at China. The point I'm trying to make here is that, like the father of economics, Adam Smith, said, free trade is the way for all economies to prosper. If you do not support free trade and if you start engaging in protectionism, by almost an iron law, you can definitely assume that economic output is going to go down, or it may not have gone up as much as it would have otherwise. So, I'm going to say that there's quite a heavy downward pressure on economic growth. And given that economic growth has a heavy downward pressure, I don't know whether we're in for a huge bull run as we had seen in the past few years. Although some fund managers like Saurabh Mukherjee are saying that if Shakti Kanta Das cuts interest rates and if BJP, that is the ruling party, spends more in terms of their budget, which I don't see them doing right now. I think our ruling party is a little more towards the fiscal prudence side rather than fiscal spending side. They're more in the belt tightening region. And I don't see Shaktikanta Das running in a hurry to cut interest rates anytime soon. because inflation is still at 6%, and your inflation is at 6% and your interest rate is at 6.5%. So I don't think Shaktikanta Das has much room to cut interest rates at this present moment. But that being said, anything is possible, of course. But I sense a lot of downward. I sense a lot more downward pressure than I do upward pressure on prices. So that's as much as a diagnosis as I can give.
Yeah, and I want to say one thing which is also everyone should keep in mind is when we say foreign institutional investors are selling, it doesn't mean they're selling everything and walking away. This is a thing that's very confused by a lot of people because the media plays it up and they compress data and they want to sell headlines, so they sell it like that. Foreign institutional investors, when they say they're selling, we mean they're net sellers in a given day, like on last market operating day, they buy and sell quite a lot. So they themselves are also still invested in Indian markets. It's not like they're selling everything and they're moving out. So Shashwat is completely correct in what he's saying that you should keep in mind. They are also juggling things around and they also move. Like the way we saw Indian hotel stock suddenly surging after the earnings call was given on Indian hotels. And rest of the Tata stocks were taking a solid beating. Like Tata Motors was taking a solid beating because of its performance and earnings. But Indian hotels was showing a bright side. So immediately the stock prices were being pushed up because foreign institutional investors started piling on. Not only them, others were also piling on. I'm not saying it's just them, but that gives you an idea on what happens. So they're also looking for pockets of value, like how we also look for pockets of value. They are also looking, but they are far more willing to venture out into small caps. They're far more willing to venture out into micro caps and mid caps than we are. We usually refrain, being small investors who really do not know much about Indian market and we do not know about the owners and the people running it. We would not want to gamble away, whatever little capital we are willing to put into the market, like the Tiffin coffee range. Even if that Tiffin coffee becomes zero, it still hurts. Even if we lose 50 rupees, it hurts for every one of us. We all suddenly think we had 100 rupees in our wallet and we keep searching here and there and we like look up and down for it. We don't walk away saying, it was just 100 rupees, forget about it. So every kind of small amount hurts. So that's the main reason why we usually don't venture into mid caps. We don't venture into small caps and micro caps because we do not know the quality of the company. We do not know the quality of the promoter. But foreign institutional investors don't mind, especially when the markets turn volatile. They are more willing to take gambles, especially when large cap companies like our Trent, our Titans, even your favorite Page Industry. I'm not talking Shashwat, I'm talking about our viewers. Some of you like Page Industries. All of these are multiple earnings, crazy earnings. So those foreign institutional investors feel there's not much gap there for Page Industries or Trent to go up any further. It won't double. But if I take a company which is at the lower spectrum and I dump in it, there's a chance it might move forward. That said, a lot of you do ask us, then if this is the case, Vinod, why don't they start dumping into Natco? Why aren't they not dumping into Dr. Reddy? These are, quite severely low PE ratios, and they're great companies. And you guys say they're great companies. We talk about the promoters of being of quality. Then why aren't they grabbing and pumping these stocks up? Well, that is a great question which we can't answer because Mr. Market, the way he behaves collectively, is very hard to decipher. If anyone claims they can tell you why a certain stock is going to be bought or sold, then they have either some extraordinary skill of being like an astrologer or they're selling me some wind which I don't want to really breathe.
I mean, to
So,
that, I'd like to add on that could simply just be oversight. I mean, institutional investors are not gods. They don't all they
yes.
see. I mean, look at the Indian market alone. The Nifty 50 has 50 companies to keep track of, and then if you expand your scope beyond these 50 companies, you have hundreds of companies to look at. Of course, one or two are going to slip through the crack, and institutional investors can't move positions at such a huge amount to, let's say, buy Dr. Reddy or something, because just market impact alone will send that stock soaring. So they're better off buying the Chinese index because you have this huge index with the ability to absorb the liquidity which you want to put into it. They might as well end up doing that because one Dr. Reddy stock is going to the amount of money which they would want to put into it might just move the needle too much. So, and it's as simple as oversight. You see one good opportunity there, and you see another less shiny fruit basket here. Yes, you could search through the fruit basket to find a very, very shiny fruit, but you would rather walk over to another fruit basket which generally seems very shiny rather than trying to look for one very shiny one through the initial fruit basket. So, what I'm trying to say here is that you can't expect foreign institutional investors to be perfect players of the game. They play by different rules than you and me.
Correct. And remember, all participants in the market are not robots, though now everyone's talking about AI and all that. Everyone, most people participating in the market, I would say 99.9% are humans, even if they're using AIs, AI-driven tools they're using. So human beings, we are susceptible to emotions and psychology, and we are fallible, and we don't do perfect things. And that is what Charlie Munger and Warren Buffett have historically taken advantage of. They count and they bet on the fact that we act like we go into manias and we overreact and have knee-jerk reactions. And we have seen this happening, repeatedly happening in India and in US. Even right now, when Trump got elected, he's not taken possession of the office. It's only in Jan, right? He has to step into office. Then by the time he sits down and he starts signing things into law and passing rules, we're talking about middle of next year. That's miles away. But the American market started surging in full excitement and went through the roof because he got elected. That doesn't make any sense. There's no clarity, there's no change in anything, but in the hopes that something is going to happen. Then the minute he says something or some cabinet appointment happens, there's some negative news about it, or there's some negativity in it. Immediately they start dumping stocks. Like they started dumping pharma companies as today, as soon as Robert F. that Kennedy guy got put into health secretary, a lot of vaccine companies got dumped just because of what he has said in the past. See, people say a lot of things to get elected. People say a lot of things to, to the base, for the base to rally around them. But once they are in positions of authority, they behave very differently. We have seen this throughout history. Even dictators, even, fascist people, once they are in positions of power, they behave very differently from the time they was in the pulpit talking, because that's the way it is. It is not easy to govern. Kennedy is not going to walk in there and say no more vaccines in the US. It's not going to happen because it just doesn't make logical sense. So to react like that, I understand, but that's how Mr. Market is. So people like Warren Buffett, Charlie Munger, and us as value investors take these opportunities and say, okay, you don't want it. Fair, well and good, we will take it because we see the value, how it's going to be. And end of the day, you should remember someone like Donald Trump is only going to be there for 4 years. And in the US, fortunately, everyone gets time 2 times to sit in the chair, and he's already finished it once, and this is his second time. And after that, there's no more Donald Trump. Like there's no more Obama. Even if the Democrats want to wish Obama to come back, he can't come back. So same way with Donald Trump, even if the Republicans want to wish him to come back, he can't come back. Maybe someone who's close to him or someone who aspires to be the next Trump may come back, but Trump himself cannot come back. So keep that in mind. So this is why when market reacts, it's an opportunity for us. And even when we're talking about his tariffs, America does not produce every single product it needs to make products within America, right? So even if they don't want to import finished goods, they want to put factories inside to assemble their own goods. They still need basic components. If they build the factories to make those basic components, they still have to import the raw materials for it because every single raw material is not available in the US. And you have to realize this is capital expense. It takes a long time to build a factory. After you build the factory, it takes even longer to train the workers to work in those factories. It's not like it's like a shop where you just turn on the lights and stock things inside and people start making things. It doesn't work like that. These are huge investments, and they have a failing infrastructure already in the country. Their roads need work, their bridges need work. What America invested in, I would say probably right after World War II, they're still piggybacking on all that. So, so keep all that in perspective when you read the news about Trump, when you read something about some cabinet position, and what is it going to do for us? And this is where my basic issue is with all of us. This FII leaving, FII selling, all this Trump, it's all noise. It's not signal. For us, signal is the stocks we are looking at inherently. If because of all that noise, we get a signal to look to take a consideration of an ATCO, to take a consideration of a Tata Motors, we should take that opportunity. That is where we should have the confidence. It gets really crazy if we start believing the signal, leaving the signal and believing the noise, where we run after the noise saying, okay, if FIs are dumping Tata Motors, that means something is wrong with Tata Motors and Tata Motors is going to disappear. So we should not buy Tata Motors or we should not consider Tata Motors, which is kind of a crazy thing to do because fundamentally we should know what Tata's the company is, who they are, and the family behind it. They have a 150-year history behind it, and the size of the empire of Tata's is huge. So to think Tata Motors is going to disappear overnight is kind of crazy. This is the same principle which you should have with even smaller companies. When you take, like a Natco. Natco is not as big as Dr. Reddy in size, but if you take the time to get on to the conferences which they have, if you don't have the time, read the transcripts at least and see what is the promoter, the owner of the company thinking, what is the roadmap he's laying, and is he being honest? Is he being frank when he's talking to you? If that happens, then you have someone you can partner with. That is someone you can invest with because that businessman believes in what he's doing and he's open and transparent. So when you share your money and invest in his business and want to be owners with him, he is going to take you along for a ride where if he makes money, he makes sure you also grow with him. So that is the kind of attitude I want people to focus on more than worrying about what the FIIs are doing and why they're doing it, is what I would say. What do you say, Shashwat?
I agree with you, and I think that this is a start of something. Maybe let's see whether how the economic growth for our country goes, and let's see how world events turn out. It depends on when Trump comes into power, what he plans to put into force, and what Jerome Powell decides to do in return. If Trump is going to really put up those tariffs like he's saying, and Jerome Powell's forced to keep interest rates where they are, I could see things getting worse. But there are a lot of people, a lot of Republicans, though, who have pledged support for Trump. A lot of them still renege on that support for Trump and talk out openly on it. So I'd say let's give it time on that end. And in general, I agree with you. I'd say we have to wait and watch and look for value. That's the only thing we can do as value investors. And finally, speaking to FIIs and their moves, like you said, Warren Buffett and Charlie Munger end up benefiting from mistakes other people make. So if there is a gem which they've forgotten about and they've dropped it, or it's on the ground, 10 rupee note on the ground, then you don't say that, oh, if that was a real 10 rupee note, the guy in front of me would have picked it up. Maybe he didn't see it. Maybe he is blind. Maybe he doesn't know what a 10 rupee note looks like. But nothing stops you
True.
from going and picking it up. I'd say that we have to keep on the lookout and value investing through times of uncertainty in small amounts is, I'd say, the best way of going about things.
Correct. And keep a couple of things in mind. When Anand keeps saying there'll be a time when DIIs can't buy, it's not that the DIIs will run out of money to buy. It's just that a certain chunk of DIIs have also have customers who have been sipping through them and they've been seeing returns for the last 5 years, 6 years. And when these people who have been sipping don't see these kind of returns and they start to see the returns dwindling, and they start feeling that their money is better served for them in a bond or better served in gold, or it's better served even keeping it as a bank deposit, and they feel they're going to lose their money, and people slowly start pulling money out, it has a domino effect, and DIS can start also withdrawing money. Because if people have put money in the market, say, please return my money, they'll also be forced into selling. So that can also get into a feedback loop where the news starts spreading and more people start selling and pressure can mount on the market. So that gives another opportunity for us to enter the market. Keeping all these pieces in mind, that's why Anand repeatedly keeps saying, my brother, that stay in the market in different coffee levels. Please do not get into lunch, do not get into dinner, do not get into any other budget which you've been dreaming about or throwing your whole savings into the market, because we are nowhere near the beginning of the start towards a downward trend. All we're seeing is fluctuation and violent fluctuation. It's like a aircraft being in turbulence. That's all it is. It's not going to crash. Just because the aircraft is having some turbulence, it doesn't mean it's going to crash. I know, being new flyers sitting in the aircraft, you feel nervous and you feel anxiety. But Anand, who's a pilot, who's seen these kinds of scenarios, he's telling you, don't worry, we're not crashing. This is just turbulence. If the change is there in any situation, if the pilot starts saying Mayday, 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 you know, starts calling that out and says brace for position, at that time we will have a different conversation. So I think that wraps up our first live endeavor. And I think it's been rather entertaining for me and Shashwat, to say the least. Next time around, we'll try and pull in my brother also, and maybe I have three bobbleheads, or at least have Anand and Shashwat here talking to you guys. So have a wonderful weekend. Do stay safe. Do enjoy your weekend in moderation, as they say. And me and Shashwat will see you again soon with another video with maybe a detailed analysis about a company or something in the American market or something else we found which we thought we could share with you guys. Anything else you'd like to say, Shashwat, before I sign off?
No, that's about it.
Okay. So thank you guys. Thanks for joining us again. And me and Shashwat will see you again in another video soon. Thank you. Bye.
Thank you.